Good afternoon. Central Bank of Nigeria Communique number 90 of the Monetary Policy Committee meeting on Monday and Tuesday, July 22nd and 23rd, 2013. The Monetary Policy Committee met on July 22nd and 23rd with 10 out of 12 members in attendance. A new member, Mr. Stephen Orosaye, who is a board member, replaced Professor Sam Olofin, whose tenure as a board member had expired. The committee reviewed the economic conditions and challenges that confronted the domestic economy in the first half of the year, particularly since the last MPC meeting of May 2013. It also re-evaluated the short to medium-term risks to inflation, domestic output, external balance, and financial stability. International economic developments. Global economic recovery remained weak as new risks have emerged, including the possibility of a further slowdown in growth in the emerging market economies. The old risks of recession in the Eurozone have persisted alongside slowing growth in China and the possibility of tighter financial conditions when central banks gradually exit from their current monetary accommodation stance. Consequently, global growth prospects have not improved. Blaming weaker domestic demand and slower growth in several key emerging market economies, as well as a more protracted recession in the euro area, the IMF in July 2013 reviewed downward its global growth forecast. It also reviewed downward its growth forecast for the United States and China to 1.7 and 7.8% from 1.9 and 8% in April 2013 respectively, but raised the forecast of the UK from 0.7% to 0.9% in the same period. For the Eurozone, which has seen its longest recession since monetary union, the IMF projects a further contraction of 0.6% in 2013, which more or less doubled the earlier forecast in April. The IMF has also cut growth forecasts for Brazil, South Africa, India, and Russia to 2.5, 2.0, 5.6, and 2.5% from 3, 2.8, 5.8, and 3.4% respectively. Japan's growth rate forecast is projected at 2%, up from a forecast of 1.5%. The slowdown in global growth is likely to impact on commodity prices and thus adversely impact all exporting countries like Nigeria. In addition, continued fragility in financial markets continues to generate bouts of capital flow reversals and inflows that are potentially disruptive to emerging and transition markets, especially their currencies. Domestic economic and financial developments. Output. The National Bureau of Statistics estimated the real gross domestic product growth at 6.72% for Q2 2013, slightly higher than the 6.56% recorded in Q1, and higher than the 6.39% in Q1 2012. Overall, GDP growth for fiscal 2013 was projected at 6.91%, up from 6.58% in 2012. The non-oil sector remained the major driver of growth, recording 7.91% in contrast to the growth rate of minus 0.68% for the oil sector during the second quarter of 2013. The drivers of the non-oil sector remained agriculture, wholesale and retail trade, and services, which contributed 1.72, 1.47, and 2.90% respectively. The committee noted the continued decline in the contribution of the oil sector to overall GDP and the underlying factors responsible for this state of affairs. These factors include sustained oil theft, which has led to a decline in output volumes in the face of an uncertain international oil market and price signal, weak infrastructure, and downside risks and demand-side risks due to discovery of shale oil and the emergence of other African oil exporters competing for Nigeria's traditional oil market. Crisis. Inflationary pressures continue to moderate, partly in response to the tight monetary policy and the base effect. The year-on-year headline inflation decelerated to 8.4% in June from 9.0% in May. This is the lowest level in 5 years. Also, core inflation declined significantly to 5.5% in June from 6.2% in May and 6.9% in April. Food inflation, however, rose to 9.6% in June from 9.3% in May 2013. Notwithstanding the moderation in headline inflation, there are benign risks on the horizon, including the possibility of accelerated fiscal releases in the later part of the year and the effects of the upward review of electricity tariffs in line with MITO following the implementation of the full deregulation of the energy sector. The 6-month inflation outlook indicates that inflation will remain within single-digit territory. However, the current state of government finances is likely to generate increased borrowing. The key risks to outlook, therefore, remain fiscal operations, increased pressure on the exchange rate due to excess structural liquidity in the banking system, and the possibility of a capital flow reversal in the medium term. Money, credit, and financial market developments. Broad money grew by 0.71% as at end June 2013 over the level of December 2012. When annualized, M2 grew by 1.42% compared with the growth of 2.7% in the corresponding period of 2012. Thus, M2 growth was significantly below the benchmark of 15.2% for 2013 and 7.6% for Q2 of 2013. Interest rates in the interbank money market moved in tandem with the level of liquidity conditions in the banking system. The average liquidity ratio was 67.79% compared with the prudential requirement of 30%. Thus, the average interbank call and open buyback rates, which opened at 12.07 and 11.91% on May 20, 2013, closed lower at 10.42 and 10.29% respectively on June 28, 2013. However, the average interbank call and OBB rates for the period were 11.8 and 11.46% respectively. The recovery in the Nigerian capital market continued as equities market indicators were upbeat in the review period. The all-share index increased by 28.8% from December 2012 to June 2013, while the equities market capitalization increased by 27.3% from 8.97 trillion in December to 11.43 trillion on June 28, 2013. Improved earnings and investor confidence in the economy contributed to the upswing in stock prices. The equities market median price earnings ratio rose above the long-run median by 9% in June 2013. External sector developments. At the WDAS, interbank and BDC segments of the foreign exchange market, the exchange rate depreciated to 157.32, 161.25, and 163 naira to the dollar on July 19, 2013, from 157.3, 158.3, and 159.5 naira to the dollar on 21st May 2013. The committee noted the depreciation recorded in all segments of the foreign exchange market in the review period on the back of a general sell-off by portfolio investors in emerging and frontier markets following guidance by the U.S. Federal Reserve Bank with respect to its quantitative easing programs. It also observed that the experience in Nigeria was not unique, as the spike in the U.S. yields negatively impacted financial markets globally. However, calm has since returned to the financial markets, following further clarifications by the Fed that exit from QE is not imminent and does not necessarily mean monetary tightening. Thus, the Nigerian capital market has seen a rally, while the demand pressure in the foreign exchange market has somewhat moderated. The committee, however, noted the buildup of structural excess liquidity in bank balance sheets, which poses risks to the inflation and exchange rate outlooks. The committee noted the increase in external reserves to $47.99 billion as of July 18, 2013, from $43.83 billion as at end December 2012, representing a rise of $4.16 billion or 9.49% year to date. This level of reserves provides cover for approximately 11 months of import. The committee's considerations. The committee was satisfied with the prevailing macroeconomic stability achieved during the period, including the single-digit inflation rate, a stable banking system, exchange rate stability, favorable output growth, capital market recovery, and growth in external reserves, thus sustaining internal balance and external viability. The committee also noted the recent volatility in the foreign exchange market and recognized that the commitment of the bank to defend the currency in the face of capital flow reversal and significant revenue attrition has stemmed the depreciation of the naira. Consequently, the bank has been able to sustain the objectives of financial and price stability. The committee observed the build-up in excess liquidity in the banking system and expressed concern over the rising cost of liquidity management, as well as the sluggish growth in private sector credit, which was traced to domestic money banks' appetite for government securities. The situation is made more serious by the perverse incentive structure under which banks source huge amounts of public sector deposits and then lend same to government through securities and to the central bank through OMO bills at high rates of interest. The committee expressed strong concerns about the risks posed to government revenues from oil theft, less than expected production, new discoveries of shale oil, the fast increasing number of African oil exporters, the dwindling market for Nigerian crude, as well as the inevitability of a fall in global oil prices, as well as capital flow reversals, which may impact the current global carry trade for which Nigeria has been a major beneficiary. The committee commended the federal government on its sustained efforts towards fiscal consolidation in 2012 and stressed the need to reverse the loose fiscal stance of 2013. The committee articulated monetary policy risks of the fiscal position to include crowding out effect of government borrowing, depletion of excess crude savings, and pressure on the exchange rate. Available data also indicates that capital expenditure is the first casualty of dwindling government revenues, as available resources are channeled into funding non-discretionary recurrent expenditure. The committee considered the inflationary outlook for the rest of the year as benign. However, principal risks remain, largely due to the loose fiscal stance and rising deficit, excess liquidity in the banking system, and risk to the exchange rate due to a combination of revenue shocks and external developments. Decision. Having considered all of the above factors, the committee decided as follows. 1. By a vote of 9-1, to hold the monetary policy rate at 12%. One member voted for a 50 basis point reduction. 2. By a vote of 9-1, to maintain the symmetric corridor around the MPR at plus or minus 2%. One member voted for an asymmetric corridor of +2 and -4. 3. By a unanimous vote, to retain the CRR at 12%, but 4. By a vote of 9-1, to introduce a 50% cash reserve requirement on public sector deposits. So the 12% remains for private sector deposits. This will apply to all deposits from federal, state, and local governments on the balance sheet of banks. Thank you.